we always like to start off with our goals just to keep and manage expectations. And so what we're trying to do for you is build better portfolios that participate in the majority of the upside while also trying to minimize some of the downside. Okay. And we do this by focusing on building better diversified portfolios that are built for reasonable risk-adjusted returns. Okay, so our goal is never to just outperform the S&P 500 or to get the highest return possible. What our objective is to provide you with the highest risk-adjusted return for your individual circumstances, goals, and aspirations. Okay? We have some new portfolios coming out. I'm going to mention them briefly here today, and then I'd like you to sit down or learn more from your relationship manager. But we're going to be introducing a liquid alternative real estate portfolio, and a structured note product. Okay, the investment review. Since 1950s, the stock market's gone pretty much straight up. And the reason we point this out is that one of the mistakes that we've observed over the last 30 years is that most investors are so risk averse that they're not willing to take enough risk to make the return. And the 2019 was a great year for equities. It was a risk-on year. But if you were over-anchored in allocation or risk-off assets, you're not going to participate maybe to your liking. So we really like to use the concept of red money, green money, and yellow money. And so you have a very balanced and well-thought-out plan. And so we're encouraging the use of the green money and then the equity portfolios for the red money. Okay? And so again, since 1953 here in this chart, the market has a nice upward sloping line. And you could have bought at the bottom and sold at the top. However, there's a story in between. The story in between is that on any given day or 30-day period, the market can have severe drawdowns. So on this chart, what you're looking at is the blue lines represent a 5% drawdown over a 30-day period. The yellow lines, or the yellow bars, represent a 10% drawdown, and the red bars represent a 20% drawdown. Now, it's very difficult to avoid the blue drawdowns. If you're trying to avoid a 5% drawdown, it's going to be very hard to make any money because you really need to be taking risk and be staying invested, as we'll show you in a moment. So what we're really trying to do is minimize the red bars, okay, and maybe a few of the yellow bars. But we have to allow and be accepting of a little bit of risk if you want return to come, okay? And so again, we like to put things in perspective. The markets have done well as long as you've been predominantly in equities. And so we want to make sure that you're always balancing the risk-on, risk-off paradigm, okay? So this chart shows the growth of $10,000 in the S&P 500 from January 4th, 1999 to December 31st of 2018. And the illustration here is just that if you stayed investing, you might have had to take 5 or 6 years to break even, but in general, it's better to stay fully invested than it is to try to time the market. And we don't try to time the market for you. We are active managers. We're respectful of what's going up and down, and we're trying to lop off the majority of the down, but we are accepting of some of the ups, the small drawdowns, the 5s and 10s, in order to get you the return. So this is just an interesting chart that shows that if you'd missed the 6 best trading days, you would have made $2,000. Your 10 would have grown to 2. And if you would have been fully invested, you'd have been at $29,000. So there's a big discrepancy. So we can't time the market. We need to stay fully invested. And when I say that, a lot of people say, but Joe, we have Iran, we have Iraq, we have wars, we have the Fed, we have elections. Excuse me, we have all these geopolitical issues that we have to face. And so this time truly must be different. And this is just a nice reminder that over the last decade, okay, there's always been something. So every decade has something going on, and every year within that decade has something going on. And so last year in the U.S., it was China, trade tensions, right, and the Fed. But there's always some there's some type of factor outside of the markets that are they're gonna affect our investing. So it's just kind of fun to see here, from the Ebola outbreaks to the taper tantrum to Greece. There's always something going on, and we know that's going to happen. So we shouldn't go into 2020 thinking that there's not going to be something. There's going to be something. We just don't know what it is, and we'll be very mindful to navigate and negotiate through whatever event is thrown our way. So it's just sometimes fun to put history in perspective. Okay. If you've been watching these, you know that our updates, you know that we'll always like to talk about the investment coin. There's two sides to a coin. On one side, think risk on, that's like stocks. The other side, risk off, think bonds. And there's always a balance that we need to be doing between our risk on and risk off appetite. And so the asset allocation approach is a risk off approach, and the focus investing is a risk on approach. So our focus portfolios, our focus dividend, our focus growth portfolios performed very well in 2019, and our asset allocation performed very well against an appropriate benchmark, but asset allocation has been out of favor for the last decade, and we'll show you some more slides on that in a moment. So on the asset allocation side of this chart, strategic asset allocation was working in the first part of 2019, and then strategic asset allocation made a comeback and was working better in the latter half. Now, even though the allocation started to work better in the latter part of the year, we're still on a risk-on environment, okay? So we still think that the best way to handle risk is to anchor it with green money and then take your risk in the focused growth and the focused dividend portfolios for your red money allocation. Focus investing is a return-seeking approach, okay? U.S. equities are still a top-performing asset class, and we'll talk about our views going forward in a few moments, but the risk-on has been where it's at, okay? And focus investing is outperforming other strategies that are more over-diversified. Okay, so it's still a focus market, a risk-on market. That's where we're getting paid. That's where the returns are coming from. Okay, so this again is a chart you've probably seen before, talking about your risk and risk on and risk off. There's not a mathematical right formula for this. It's who you are. Some people want to be 50-50. Some people want to be 70-30. It doesn't really matter. All that matters is that you continuously communicate with your relationship manager how you're feeling and where you're at in your financial plan, in your retire process. And if you haven't heard of the retire process, it's new and improved for 2020, new decade. I'm going to have to learn how to say 2020. So we encourage you to go through or update your retire process. Okay, so risk on, risk off. Again, we've been getting paid. The money's been coming from the risk on investments. Fundamental versus technical. Those are two different tools that we use, or two different ways we use to analyze and make decisions. So sometimes we're using all fundamental skills, sometimes we're using all technical skills, okay? And sometimes we're using both. So last year, we know that fundamentals matter, but the markets have been trading as if they don't, right? So for the last 10 years, and definitely the last few years, the markets have been trading on geopolitical event risk more so than the fundamentals of the market. There's been China and the Fed last year, and then again at the end of the year, the beginning of the year, we've had Iran pop into the picture, and that turned out to be not too bad. In fact, if you look at the majority of the periods of conflict in the Middle East, there's only been one period where there was really a large drawdown. Most of the time, it is not as significant as you think it would be on a longer perspective. On any given day, you'll see some volatility, but with the latest Iran situation, the markets have really been resilient and held up well during that. Technical. Last year was a difficult year for technical analysis. As we talked about in our prior market updates, it's been a mean reverting market. So it hasn't been a trend. We lost momentum in the year. Momentum is coming back, but in the beginning of the year and throughout the first part of the year, we had lost that momentum, and it became a mean reversion trade, which is harder for us to make money on, right? That's why a buy and hold year was in favor over that technical analysis. So last year, fundamentals we're working a little bit better than technicals, and we'll see what happens this year. Okay, active and passive. So active or tactical allocation strategies have been working really well for equities. They have not worked as well in the allocation space. And then in general, it's been more of a buy and hold year, worked well in 2019. Again, we'll see what works this year. We're just starting the year off. We think we're going to have lower returns for longer, and we'll keep you posted. We'll always, the most important thing to understand is that we're adaptive. Our team of analysts is always looking at this data. We're looking at the math and science, the preponderance of the evidence to make good decisions. And so we will always be tilting between our work on passive and active and fundamental and technical. So you don't have to worry. We'll take care of all that for you. Okay, let's review the past. So the geopolitical frictions are the principal drivers of the market. Like we just mentioned, they're haven't been the fundamentals. The fundamentals matter, but the markets and the volatility have been based on these news event cycles. The Fed is probably neutral for 2020. They were accommodative in 2019. This year, we're not looking at any evidence that we should really have a rate hike or decrease in rates. So we're expecting the Fed to be pretty benign this year. U.S. equities are slightly overvalued. Looking at a forward-looking price-to-earnings ratio, which is a measure of value. However, the interesting fact here is that 50% of the companies in the S&P 500 are actually below their PE ratio. So what's happening is that you're having a lot of the large cap tech companies that make up the top 5 or 6 companies of the S&P 500 really performing well. Your Apples, your Googles, etc. And they're driving because it's market weighted, they're driving the valuations higher, but all of the other constituents in the S&P 500, there's a lot of value. So what does that mean? That means it's still a stock picker's market. It means that our focused growth and our focused dividend portfolios would still be expected to outperform. U.S. growth expectations are still lower. We're in the 1.8 to 2% growth rate in GDP. Again, it's below the 3.2% average, but we can grow at 2% for a long time. And we didn't have a recession. And we'll talk about that this year. We don't think we're going to have a recession in 2020. We did have an earnings recession last year where earnings dipped, but earnings are coming back and they're looking good so far in 2020. There's still continued elevated macro uncertainty, but it's smoothing out. Again, this is an election year, and we'll talk about that in a few minutes. So it's nothing to be worried about. It's just something to be mindful of. Current expansion continues, so the economy is still doing well. Inflation's still in check, even though we think it'll be up a little bit higher this year than last year, maybe in the 2% or a little slightly over 2%. An interesting fact here is that last year was a great year in the market, a historical year for equities, but bond ETFs took in record deposits. So the smart money, or what we call the large institutions, were actually de-risking in 2019. The large smart money institutional portfolios were actually selling equities into all of this strength and rotating into bonds. So most of the institutional investors did not end up with an S&P-like return. Their return was quite lower because they were selling equities and rotating into fixed income. So it was just an interesting observation. And we think that we're going to show you a chart here towards the end of the presentation today based on sentiment. We think it's a positive factor, but it's just interesting to note that year that the market was record high, you think all the smart money institutions would be all equity and taking advantage of all of that return, and it's interesting to find that's not the case. Okay, here we have an S&P risk-on portfolio versus a risk-off diversified portfolio represented by 40% stocks, 15% international stocks, 5% small cap, and 30% bonds, 10% high yield. So a globally diversified asset allocation approach. And what you'll notice here is that in the 2000 to 2002 period, you lost less money than the S&P, but you still lost money. The next period shows that you were up 73%, but you didn't make as much as being focused. And then you lost money. Then in 2009 to 2019, you didn't make as much. And so if you look at the last decade, asset allocation felt like it was broken, but if you look at the last 20 years, asset allocation still prevailed. It's just been a hard road to go. Because we've been in such an accommodative economy and we've been on a risk-on environment for the last decade. And so we see that here. We see on this chart that during the 2010s, we have bonds that were up 3.8, stocks were up 13.6, and international stocks were up 5.5. So again, the prior slide shows you allocation from the 2000s. And so over that 20-year period, asset allocation worked. But over the last decade, the last 10 years, it's really been an equity-driven market. Okay, so that's where we're at in that risk-on, risk-off paradigm. 2019 was a historic year. Again, you're going to see numbers that show the S&P returns in around 28%, and you'll see them in the 31% range. The difference is whether you reinvested dividends or not. Okay, so everyone says, well, after such a great year, can we do it again? And this chart just shows what some of the returns have been the following year after a stellar 30% year. Of course, nobody knows what 2019 will bring, but we can just look here to see that in 1985, stocks did 18 and bonds did 15. And during a 31% return in 1989, stocks followed up with a negative 3% return, and so forth. So we think we're probably going to be in the more of a historical norm, 5.5, maybe 5 to 7%. Again, the market has run up. We've seen a lot of those values come to fruition, so we're not expecting to see another 30% year. Now, earnings could surprise us, and that could happen, but the data that we have today would be in more of the single or mid-single digits. So that's where we are with the historical perspective in mind. Volatility, something I look at all the time. You'll notice here that the white lines represent a positive 1 and a negative 1% move in the S&P 500 on a daily return basis. And you'll notice that the last quarter was contained. There was not a lot of volatility. There wasn't a lot of breakouts in the last part of the year. So the fourth quarter was pretty low as far as volatility was concerned. Long-term volatility, you can see, has been those spikes we've talked about in the past between the fourth quarter of 18. But right now, volatility on both a short and long-term perspective is looking okay. Again, what we can't model in are these unexpected volatility shocks from some type of event. Those will still happen. But for the most part, we're not overly concerned with runaway volatility. Okay, so focus investing versus asset allocation. We always like to present the two sides of the story. So on one side of the coin, we have the S&P 500 represented by the blue. That was up 32% again, depending on the data provider and with or without dividends. And then the U.S. passive fund allocation from Morningstar, who's a industry standard of a data provider, shows that the allocation did about 18%, not just shy of 18.61. So again, you got paid to be in the S&P or be in equities more so than you did to be in asset allocation. We look at active versus passive on the value side. So last year, the U.S. active fund manager in the value category was 25 compared to the passive of just about 27. So again, we saw here, passive worked a little bit better than active at an index level. But our portfolios perform better than that because we're looking at bottom-up stock picking models. So we performed a little bit better. Active versus passive on the growth side, we can see here that the passive growth was at 33.44, and the growth was at 32.7. And so they're pretty close. And right now, we're recommending a split between our focused dividend and our focused growth. So it's a little bit of value, a little bit of growth. We started that recommendation last year, and we're continuing to hold that. We would like to see you taking that equity exposure in a blended manner. Okay, so what's worked in the past? Last year, risk asset stocks worked, buy and hold worked. Being fully invested worked. What didn't work, what detracted from those returns were risk-off assets or being over-diversified, holding too much cash or shorting the market. Now, one mistake that we made last year, which I don't know if it's a mistake, but I think it was a good decision at the time, and we would do it again, is we did hold cash throughout the year in all of our portfolios. So we still performed well, but we were cautious coming into last year. So we did maintain some cash in the portfolios throughout the year. And of course, that detracted a little bit from returns. Not much, but a little bit. This year, we are holding just a little bit of cash right now. And you may see us raise that as the year goes on, as the elections become closer and we're getting a better read in the markets. Picture becomes more clear about what might be happening on the political front. You'll see us adjust cash. So you don't have to worry about that. We're already thinking about it. We're hopefully a couple steps ahead of you, and we'll be mindful of that cash management. Okay, in 2019, again, the equity strategies were the #1 strategies. In the asset allocation, the sailboats were the best performers. Again, they started off slow in the beginning and the middle of the year, and then they had a good fourth quarter. The tugboats started off stronger and then faded off towards the back of the year because of the rotation between strategic and tactical management. And then the speedboats were in third place. Fixed income did very well. For the fixed income space, it was a good year for fixed income, but it is fixed income and the returns are lower than the allocation models. So we would go equities, first, then allocation, then fixed income. And that's the order of the portfolios for last year. Okay, what's going to happen? This is fun. Everyone wants to talk about impeachment. So impeachment is a really hard risk to handicap. If it goes like Clinton's trials went, it wasn't really a big drop in the House. You can see here what the S&P 500 did in the white line. The orange line is the 10-year Treasury, 10-year, 3-year spread. And you can see the point of impeachment in the House impeachment and the acquittal by the Senate. And you can see that the U.S. equity markets really handled that pretty well. If it was like Nixon, if it's going to be something more severe like a Nixon event, then the market it did fall more than 20% during that impeachment hearing. So that gives you a little bit of understanding. We can't predict it. We don't know what's going to happen. But that gives us the evidence of the last two impeachments, and we'll just stay tuned. The next big one we have this year, other than impeachment, is the re-election. And so what happens during a re-election year? Everyone's worried about that. Well, on average, that last year is about 5.7%. So the last year of a first-term president is about 5.7% and was positive just about 73% of the time since 1932. So you can see here that the election year is the lowest of the years between first term and second term, but in first year and second year going throughout the term. But we're not expecting a large drop-off. So that 5.7% average is very close to our expected return of about 5.5% in the market. So there is a little bit about the election cycle. The next one, so we had impeachment, we have the election, and the other big one we get is recession. And so right now, we don't see the probability models predicting a recession in 2020. Both the Fed model and the Bloomberg model. The Fed model is the white line. The Bloomberg model is the orange line, and both of those are below 25%, or the Fed is below 25 at 23, almost 24. Bloomberg's at 28. As you can see, they've both come down from last quarter, and so that recession risk has been reduced since last quarter. So we don't see that happening. Again, things can change. We'll keep you posted, but as we start the year, the probability models of a recession are quite low. Okay, yield curve. As you've heard me say before, there's only three things that drive equity markets. That's the interest rates, inflation, and yield curve. Or I'm sorry, interest rates, inflation, and earnings. Here we have the yield curve, and you'll notice that it's starting to uninvert. So we've had an inversion yield curve, meaning that lower term rates were higher than long-term rates, and we're starting to see that flatten out. We started talking about that in our last quarterly market update, that we'd expect to see the Fed to help flatten that out. We've seen that happen. We still have a small inversion, but interest rates are positive at the moment and starting to steepen, so the shape looks okay. Now, where should rates be? Have you seen this before? We always look at the Taylor rule to say where should we be. The Taylor rule estimates about 5%. We're currently at 1.75, so you can see the gap between the yellow line and the blue line is still increasing. And so rates don't seem to be a problem right now. By the own admission of the Fed, when we look at the dot plot, you can see that rates here by the Board of Governors are still looking to be very low in 2020, below 2%. So rates don't seem to be a problem. Now, the next slide is kind of fun because don't bet on the direction of rates. We don't make bets on interest rates. We deal with what we're given. And in fact, here by the Philadelphia Federal Reserve survey of 30 plus Wall Street economists, 57% incorrectly predicted the direction of interest rates, and only 43% actually got the direction of interest rates correct. So as you can see in the chart here, I won't read it to you, but you can see that more than 50% of the time, the most sophisticated economists actually forecast incorrectly. So there you got the rates. We're not overly concerned with them at the moment. We look at the valuation in the market. Here you can see that the white line representing the forward-looking PE ratio is a little higher than the 5-year average that's represented by that green line. And so market is a little bit overvalued, but again, like we talked about, that's a lot of that overvaluation is coming from the top 5 or 10 large cap tech stocks and all those familiar names, and the FANGs and the Facebooks and the Amazons, the Googles, okay? And so the constituents, there's breadth in the market. There's still a stock picker's market. There's still some value to be had there, but just not at the index level. Okay. So if we break that down to a bull base and bear case, you can see that the base return is 4%, a bull return would be 7%, and a bear would be down 17%. So what would have to happen for those scenarios? Well, earnings per share growth is we're assuming about a 2% growth rate for a base, 12% for a bull, and a negative 14% or a decline in earnings per share of 14% gives you the bear case. So I think that we're somewhere between the base and the bull case. Right now, we're at probably, I'm guessing earnings to be about a 10% growth rate, and we're looking at the S&P in about the mid 5.5, so about mid single digits. So well within tolerances of these bull bear cases here. So what does that mean? Well, that means for a 60-40 portfolio, an asset allocation portfolio, where you put 60% in U.S. equities and 40% into fixed income, you're still expecting about a 5% return portfolio. So again, that's in line with our risk-on, risk-off paradigm at that 5.5% range. If you're doing 50% green money and 50% red money, you're going to end up with an expected return in that 5% range. Asset allocation in general, we would say should be doing about 3 to 6% with risk 9, 8, let's say 8 to 10% range. We'll show you a chart in a moment. And the S&P 500, which is the broad-based U.S. equity markets, we're expecting probably 5 to 7 with risk in the 15% range. Here you can see the actual distribution for allocation. So what this says is that 90% of the time, asset allocation returns are going to be between -8 and 21.5%. And on average, they're going to be 6.6. And so again, that data is collaborating and it's right in the middle of what we expect. And so again, looking at the preponderance of the evidence, we feel comfortable we don't have any outliers. Okay, for the focused dividend, the focused dividend portfolio's expected return over the next 12 months is just shy of 8%. And you'll see the expected return on the S&P 500 is about 5.27. The dividend yield is 3.92 on our dividend portfolio compared to 2.2 on the S&P 500. So what we're trying to do in this portfolio is give you a one-year expected return higher than the market with taking equal to or less than risk in the market and doubling the dividend yield. And so you'll see that this is coming true. This was our best performing portfolio last year, and we still favor dividends just a little bit over growth. Okay. The focused growth has a one-year expected return of 7.4 compared to the 5.27 on the market. And again, the beta is about 1. So on this portfolio, we're trying to hold 5 to 20 stocks that'll give you a one-year return expectation in excess of the S&P 500, again, with the same or less than risk so that we have a nice risk-adjusted return opportunity. For the focused bond portfolio, which is a bond portfolio that holds between 5 and 20 individual bonds, our yield to maturity is just shy of 3% compared to 2.3 on the index. Our modified duration, which is a risk measure, is 3.8 compared to the index at 6.3. So this is the biggest difference. We're getting a little bit higher expected return for half of the risk of the market. And so again, a very nice risk-adjusted return opportunity set in individual bonds. The bond portfolio pays a coupon of 4.67 compared to the index at 3.4. So you're getting a high amount of income, a high amount of risk-adjusted total return, and you're doing that in a high-quality investment-grade bond portfolio that rates out at BBB or better. It's a little higher risk than the AA of the benchmark, but that's, again, the risk that we need to take. It's a measured risk in order to increase the risk-adjusted total return perspective. So the bond portfolio is positioned very well. Okay, so overall, U.S. equities, we're still bullish on. We also put a neutral out on it because we are late cycle. We don't expect a 30% year. We expect it to be more of average, so we're still pro-equity over fixed income, but we're cautious. International equities, we're neutral. Emerging markets, emerging market equity, we're bullish to neutral on. We think they'll perform a little bit better than developing international markets. But again, both international and emerging markets, I think, will take a backseat to U.S. equities. In a diversified portfolio, we'll be holding all of these asset classes, but In our focused growth and focused dividend, they're going to stay predominantly U.S. focused. Fixed income around the world, we're neutral. And U.S. real estate, we think there's some really good opportunities for income there. We are late cycle, so we're neutral on that just because of where we are in the cycle. But in general, the multifamily space is still expected to be the best performing real estate space, and we are pro real estate, especially by adding real estate to your portfolio for a long-term, well-diversified portfolio. So we might have some short downturn risk in real estate, but we still like it as a long-term asset class, and we have some new ways for you to add that to your portfolio. So again, as we mentioned in the beginning of the video, talk to your relationship manager about the new liquid alternative real estate portfolio. Of course, we have the non-traded REITs and the Delaware Statutory Trust, aka DSTs, for people that need to be able to do their tax-free exchanges and sell your real estate high up here in Seattle and buy low in a lower market and do that tax-free. That's a Delaware Statutory Trust. So again, mention those to your relationship manager. This last slide here, we talk about the sentiment suggests that the bottom is closer than the top. And so what this is looking at is institutional investors' confidence. And you'll see that it's quite low and that they've been very defensive. And that I told you earlier that they moved a lot out of equities and a lot into bonds last year, which wasn't the right move because equities did so well. So what does this mean? Well, what this means is that the markets usually don't start a bear market or a severe pullback without institutional volume leading the way. And right now, because the institutions are very defensive, they've rotated out of securities and into bonds, okay? There's less chance that the markets get overheated by that. If they were all very confident and been loading up on equities and rotating out of fixed income, that would make the market more overvalued. It would be more concerned about that. So based on this sentiment indicator here from the State Street Investor Confidence Index as of the end of the year, that gives us some comfort. So we're not expecting the bottom to fall out. Again, if institutions start rotating back into equities or even become more bullish or their sentiment comes up, that's going to be a positive thing. So that's why we think the bottom is closer on the sentiment than the top of the sentiment index. So that's a very positive factor for us. So going forward, we're still expecting lower returns. The Fed inflation's right around target. It's not going to run away. Again, 2.5%. The 10-year, we'd love to see it come up a little bit. We think maybe in the next year or so we'll see rates start to come up, but it's still a wait and see environment. Active tactical management in the equity space is paying off. Asset allocation and a risk off strategy will start to come back if we get into more volatility and we see a recession starting or we see a bear market starting. So that may become popular again. Corporate earnings, I think, are going to be above their long-term average, but they're not going to be in high double digits. So we'll keep an eye out on that. But all in all, interest rates look okay. Inflation looks okay. Corporate earnings look okay. So we still expect the equity markets to be in the place to be over your risk-off assets. So with that, I'll let you read the last slide here by Peter Lynch, which is always interesting. But we'd like to thank you for the time. If you have any questions, please call. Make sure you go through the retire process. Make sure you're keeping a good balance between your green and your red money. And make sure that you're communicating any changes in your circumstances to your relationship manager so that they can adjust the portfolios or reallocate your portfolio as necessary to make sure that you're getting enough return for the risk that you're willing to take, or that you're not taking too much risk that makes you sleeping tight at night. So with that, I'd like to thank you again for this time together, and we'll see you next quarter. Thank you very much.